G'day and welcome to the Investor Motivation Podcast. My name's Robert Goudie and from Melbourne I've joined by Ash, one of our
What?
long-term advisors and partners.
G'day, Rob. How you going?
Good, mate. You've had a good
Sure.
week?
Had a busy week. Yes, absolutely. What about
Fantastic.
yourself?
Now, we're on the wind down in December. It's the 12th of the 12th, 2025, and today we're going to have a bit of a chat around, I suppose, just some case studies. So a couple of examples that you've had during the week that were of interest to you, and I've got a couple of, very brief scenarios about what I thought was interesting throughout the week and how we're handling things and how it ultimately affects our clients' well-being and getting as good financial results as possible, which of course that translates into overall well-being results as well.
That's right.
Yeah. So Ash, let's kick off with you. You've got I suppose you've had an interesting week. A bit of, I suppose you've been on call. You might need to be a witness in a scenario where there's a bit of a family dispute, and these are things we see a little bit too often. Now we're not going to go into how do we avoid these because sometimes they're unavoidable, but it is all in relation to a bit of aged care.
Yeah, it seems to be the topic for me in the past few weeks, particularly in the lead up to Christmas, Rob. Lots of families are getting together and talking about,
Yep.
how the mum and dad's, care needs are being supported, and residential aged care is often the topic of conversation around the family table. Yeah, you're quite right. A couple of interesting cases, which we'll chat about now without naming names, of course. But I guess the idea of this one is just to let whoever's listening out there just know of some of the risks and what to look out for when we're sort of making some decisions on behalf of our loved ones. So acting as power of attorney and such.
Yeah, and obviously family dynamics, and obviously it sounds like that around Christmas and post Christmas is where aged care for you probably goes up a notch, where families are coming together. So that's been a bit of a theme over the last 10 years plus that you've been giving advice in aged care. Has that been a reoccurring theme that post Christmas there is a spike in decisions being made for people?
Yeah, it's incredibly reliable that we know we're going to get busy around this period. And what else is reliable is when we've got to fill out Centrelink application forms. They generally take a few extra weeks longer to get processed because I
Right.
guess half the workforce, going through those applications are on holidays as well. So that's what we try and give a heads up to our clients, that don't expect results back when we're
Yeah.
submitting to age pension applications and income and asset assessments.
All right. And look, that poses a very quick question, and it's probably the first thing that comes to people's minds is what's the most efficient way to do that? To put in an aged care or age pension application?
Certainly will encourage you to do, particularly age pension applications, is to get it done online. So steer away from the paper-based applications and try and log into MyGov and link it up with Services Australia to get it done that way. You can also do it from an aged care means disclosure point of view, but sometimes if you're already getting an age pension or a government payment, there's some short format forms which is pretty much just answering a few questions relating to your living situation and family home that can be quickly done. They're not too terrifying or too confronting to go through, and unfortunately we're going to send them away and we're waiting 7 or 8 weeks generally to get our results back, but that shouldn't hold up an residential aged care admission, but the facilities may just have to wait a bit longer to understand your financial position.
Okay, so
Yeah.
MyGov, link Services Australia, go through the processes there, and if you're already receiving a pension, to go and do the aged care stuff online as well, because they've got most of your information. They're not too difficult of forms.
You've already disclosed most of your assets there. Just make sure that you're confident with your level of assets, which Centrelink know about, so the value is accurate because your fees are going to be calculated against what they have on file. So
Right.
if
And for
you're drawn down on cash or super, make sure you let them know the new balance.
right. And for self-funded retirees that haven't disclosed, that's obviously a bit more of a detailed process for them. Where people, just have substantial assets, do you even need to disclose everything, or do you say we'll just pay max because we know we are over every limit available?
Yeah, it can be case by case. I would encourage your clients to at least ask the question, maybe even from an advisor, to say, okay, well, should we be disclosing assets? Sometimes it doesn't make sense to, if your assets exceed, let's say, about $2 million each, tends to be the sweet spot.
Yeah.
That you go in as non-means disclosure. It speeds up the process. You're likely going to be charged the full fees anyway. But if there's a chance where you could minimise your daily fees, your daily amount, because at the end of the year, your annual amount tends to be the same because it will cap out at some stage through the year. But if you are disclosing your means, sometimes you get a cheaper daily amount that when we start to talk about a life expectancy and let's say the individual passed away at some stage through the year, Rob, they may have paid less fees during that period through the year. So there could be some savings on offer there. This is getting into the technicalities. We might lose a few people on that, but just have the conversation with an advisor.
Yeah, so, get advice. Regardless of your scenario, get advice. There's always, there's strategies and things that you can implement. Very good. So I've distracted you completely from your case study. The first one you're going to have a chat about, then I'll have a chat about my first case study, and we'll do two each.
Sounds good. Right, to give you a rundown of the situation here, I've got a client whose husband went into residential aged care. They needed to redeem an asset in order to pay a refundable accommodation deposit for aged care. In most cases, that tends to provide the best financial outcome because we get to minimise our ongoing costs. Yep. So the asset in this case that was redeemed, there was an anticipation by the four children that they may have received that as part of their inheritance at some stage in the future if something happened to the husband that went into care, and because that asset was sold and paid as a deposit, they've seen their inheritance disappear. Now, realistically, if we're paying deposits for aged care, that forms part of an estate that gets paid back. They may not have been aware of that. But the takeout message here, Rob, is to include the whole family in these conversations about aged care, because there's more than one interested party, either the husband or the wife, but we've got to make sure that the children or beneficiaries have some level of expectation what they may receive at the end of the day. And when, as an advisor, when we come up with financial strategies, we're taking that into consideration every time, that we may provide the best financial outcome by going down one path, but it may not satisfy goals and objectives. And these goals and objectives could be estate planning and inheritance and whatnot, and taxation outcomes and that. Yeah. So unfortunately in this position, the disgruntled children took their mum to VCAT, and that was a bit of my experience through the week, being on standby as a professional witness. But at the end of the day, the mother was acting as financial power of attorney on behalf of her husband, and in my opinion was doing everything right. So a bit of an unfortunate scenario.
Yeah, and with that, obviously, there's a lack of communication and or understanding that the disgruntled children, obviously, there are, think they've missed out, and they may just not understand that it's a refundable, deposit. The money will come back to the estate when Dad leaves the facility. So it might just be lack of communication, lack of understanding.
Yeah, correct. I agree with you there, Rob, and without sort of understanding the children's full situation, because in our part of this process, we met with the power of attorney to answer questions and provide some guidance and understanding of the system. But at the end of the day, it is quite likely that this particular asset that was sold in order to fund aged care may have been sold as part of the estate and divided four ways to then find each way to the beneficiaries there. Now, having the asset sold early on and pay the deposit for aged care, well, that deposit's in cash, highly liquid. It gets paid back to the estate and can be evenly, split up four ways. So it may have just been that lack of understanding.
Yeah, fantastic. So, as always, decent communication is a huge help to stop, these type of disputes. And VCAT sounds benign, but I was a witness at VCAT, probably 20 years ago, and these are not unstressful places to go. It's not court, but it's not far off. It's still stress. So communicate well. Make sure people know what's happening.
Yeah.
Very good. Thank you for that, Ash.
You've got one, Rob.
I do. So the first one I was keen to have a chat about was, so I've been doing lots of reviews in the lead up to Christmas, and mostly around self-managed superannuation funds. So there's two elements to this. So probably the case studies come out of one client, but two scenarios that when we are doing projections to prove, do you have enough money? I always ask that awkward question around inheritance, and it's not a question I like to ask, but it does have an impact on, the people's ability to spend more while they are young, knowing that there might be some type of lump sum. And we treat it pretty conservatively. But in this scenario, there is well over $500,000 worth of inheritance to come in. That frees them up to spend now because we put that into the projector. But it's a direct share portfolio. And so this is, I suppose, my interesting part around the case study is, we'll need some advice on what to do with the shares. We'll probably just sell them. And I said, well, what makes up the share portfolio? And of course, it's an early 90s portfolio. We see lots of these all the time. They've been phenomenal for the holders to have CSL and also Commonwealth Bank in particular. They've been what I call portfolio makers. And that portfolio means that they've done exceedingly well over a long period of time. And of course, there is capital gains tax implications. So so understanding what to do with these assets when there is significant capital gains is, and what I've explained to these clients is, and what I explain to most people where there are, there's significant holdings, a big portfolio, is they do not need to be sold within the estate. This is what most people think happens, but it's not the case. So in this scenario, it's two sisters. Half the shares can go to each other, and individually they can make their own decisions whether they sell down some of the shares progressively over time. But if it's just sold, there's going to be significant capital gains. So each beneficiary can receive the shareholding, and they can inherit the parent's cost base and therefore the capital gain. And if these are good assets that are valued and good businesses, there may be no need to sell and trigger and pay capital gains tax. So that's always been one of people's back of their mind, that that it all just gets sold within the solicitor's office. And that's quite often what solicitors do. We had one of our clients, and it was a $4 million direct share portfolio, and sale of the farm, and then back in 2001 I think it was, and build up the asset significantly over time. And we set up testamentary trusts. We had everything lined up beautifully for this portfolio to go from our client to the three beneficiaries via testamentary trust, which was really appropriate. All these people are in businesses and therefore reasonably suable if something goes wrong. So having this significant wealth within a testamentary trust really gets rid of that liability of bankruptcy or litigation. And we got the email from the solicitor saying, well, are you guys going to sell all these shares, or are we going to do it? And we said, no one's going to do it. We're going to transfer the ownership by in specie into the new testamentary trust. So that was my, I think it was a case study where I definitely answered a question on how we would handle that when you receive the assets, when down the track and you receive these inheritances. So that was a good chat. And that was my first case study. Back to you, Ash.
Just a quick question on that, Rob, while you're on the topic.
Yeah.
Let's say the beneficiary did inherit the shares and they didn't sell straight away, therefore triggering a capital gain. Let's say in a few years' time they wanted to upgrade their house or buy a new car or form part of their retirement where they wanted to start paying an income stream from that.
Yeah.
What could they look at in order to minimise capital gains tax? What are some strategies that you would recommend?
Well, thanks, Ash. I should have covered this off, that I already suggested to these clients that, of probably 600 grand direct share portfolio, that would be their half. The majority of that is going to be, CommBank, where there are significant capital gains. Now, these are all the money goes to not the couple, via the will, it goes to the individual. So the tax, the income from that portfolio goes to one person. The capital gains goes to one person. We can't be splitting it because it goes via the estate to an individual. So what I've suggested there, that I would like to lighten off Commonwealth Bank. I want to get more diversification than, of a 600 grand portfolio and 450 of it's one business. And so I would like to build diversification, is that we might sell within sort of the marginal tax rates, 40 grand per year, 45 grand per year. And obviously take into account other income they may receive, and just progressively do it over time. And of course, that money can be used for house renovations. If they need 200 grand really quickly, is the ability to put money into superannuation still there based on age? In this scenario, they're around 70 years of age and not working. So yes, they can get money into superannuation via non-concessionals, but they can't use a concessional contribution. So in that scenario, it would be splitting the gain over multiple financial years.
Great.
Yeah.
Thanks, Rob.
You're welcome. Thank you.
Fantastic.
Yeah. Study number 2 for you, Ash. We're going aged care again?
Let's do it again, mate. I found this one very interesting, so hopefully that's interesting to others out there. I've got a client who's based in Sydney. I've got a husband and wife heading to aged care at the same time. Just to really summarise their financial position, they've got a home worth $2.5 million and let's say $500,000 in addition to that worth of cash.
Yep.
Now they're heading into aged care and the facilities ask for a $400,000 deposit each. And a very, very common sort of scenario here. What I found interesting, we're modelling around what to do with the house, and in this case we're talking with the children who may have particular interest as an inheritance to receive that house themselves, so we may not have the ability to sell that. Now we're running this scenario through the calculator that in the meantime the home will be retained and there'll be a bit of rental income received from that, not a great deal, not a fantastic return at the end of the day, but a bit of income coming in. Now the interesting numbers that come out was income position is relatively high because if we're going to pay a partial deposit for aged care with the cash, that cash is going to be exempt for Centrelink, therefore we can maximise our age pension entitlements. Now the home's an exempt asset, you're classified as a homeowner, so the only assessable assets thereafter is whatever little bit of cash you've got left in your own bank account. That doesn't include the deposit for aged care, so we're going to maximise.
Cool. Question. Both, mum and dad, husband and wife, are both moving into aged care.
Same time.
Same time. Yep. So this is sort of the worst case scenario when it comes to funding this. But even though they're both out of the home, they keep the home is still exempt.
The home for Centrelink is exempt, and this is the trap or the trick into this client scenario, which is worth a conversation. The home's exempt for 2 years.
Right.
Mum and dad will be classified as a homeowner for Centrelink purposes for 2 years. And they'll get the full pension. And the full pension, couples pension combined, that's over $60,000 per year. Now, this is going to go a long way to their aged care affordability, but for 2 years. So the trap here for these clients, which they'll be made aware of, is that after 2 years, you've got no income. And the rental income that you're receiving is barely enough to cover the ongoing maintenance and cost of retaining the property. You got to think of maintenance, you got to think of agent fees, you got to think of insurances and whatnot. There's not much left over at the end of the day.
Yep.
And if all your income is then, all your age pension is going to go away, essentially the takeout here is that after 2 years you're a non-homeowner and all of a sudden you've got a $2.5 million investment property. Now you exceed the assets test thresholds, and I think it's classified for a non-homeowner, Rob, I think I'm closer to this, is 1.3, 1.4 mil of assets before you're not entitled to it. So they exceed that by a long way.
Yeah.
So at this point in time, these clients will not have cash flow. They've got an asset which is not generating much income. They may be backed into a corner where they're forced to sell that property really quickly.
Right.
Or take these significant reverse mortgages out. There's probably a couple of different things they can explore, but it's a trap waiting on the sidelines, and it will happen.
Right. And is that scenario, obviously, retain the place and maximising age pension for 2 years, that's pretty attractive in the short term.
Yeah, but we've got to have a plan in place as well that, if we can get somewhere close to, market rates return from a rental, in this situation, they knew the person that was going to rent the house, so there's a bit of a discount there on offer, which definitely will work for the first couple of years, but maybe not thereafter. So we've got to make sure that the income coming in for that particular property is reasonable.
Yes.
It's going to help provide an income stream for mum and dad moving forward. So I found this one interesting that, everything looked fine for the first 2 years, but after that, we're going to be forced to make some hard decisions.
Right. Is this where say the beneficiaries have got a preference? Say, we want to retain mum, the family home. That's obviously there's emotional attachment to this. That the kids get together and help fund the 2 years after that. Is that obviously an option and a strategy?
It's definitely a strategy. Kids can pay the ongoing invoices from the aged care facility thereafter. So if a bill comes in, it's funded by the kids, and that's a way to help preserve and protect a potential inheritance. So once
Yes.
again, family conversation is important, and the understanding there. Just be cautious. I've seen sometimes in the past where the kids have paid their mum or dad's aged care deposit. So aged care facility, let's say they've asked for that $400,000 figure that we threw up before. Now, if something were to happen to mum and dad, then that deposit gets paid back to the estate and not directly to the child who funded that in the first place. So whatever the will states as part of the estate is where those proceeds will then be distributed. So we're going to make sure communication and understanding
Yeah.
is across the family or the beneficiaries.
Yeah, that money needs to get back to the kids. Yeah.
It needs to get back. That's right.
Yeah, to the right person that provided it. Is it worth worth noting, the average tenure within a time spent in a facility is not, the average is not huge, is it, Ash?
I'll give you 2.5 years. I've heard as an average, but when we're planning as advisors, particularly in this space,
Yep.
we're planning for at least 5 years. Rob,
Yeah.
some clients will strive in an aged care scenario where they're being looked after really well.
Yeah,
So we've got to make sure the funding is there for the long term.
understand. Of course, no, of course, no one is average.
No,
Yeah,
no, exactly.
some are above, some are below.
That's right. That's right.
Fantastic.
And
Well,
just on that, Rob, before we go into the next topic, the other option for the client, and this is a scenario we modelled as well, was okay. Well, what if we sell the house now and utilise the proceeds to A, pay all the deposits off in full, because they'll have at least 400 grand each to pay, and B, invest the rest conservatively, let's say in a term deposit, paying 4 or 4.5%, generating a really good income stream. Now, surprisingly with that, and the cause behind some of these outcomes is it'll kick in a higher means tested component fee for aged care. Now, the fee is called a non-clinical care contribution. And the old terminology was a means tested care fee, but it's all changed November 1. Now, in this instance here, retaining the house, that fee was $0. Selling the house, that fee over the couple is about $76,000 per year.
wow.
Now, the reason because that's resulted was for aged care, the home has a capped value for the means test, for aged care, not Centrelink, of $210,000. The moment we sell it, all of a sudden there's 2.5 million assets sitting in a cash account that's going to be accessible. So we've really got to understand the outcomes of any transaction or any funding mechanism before we proceed. Because there's lots of traps out there.
Geez, Ash, this is one of the things always I've been impressed with the work that you do, the way that you'll provide a direct recommendation to people, but you'll say, if you do this, this is the cash flow outcomes. If you do this or this, here's 2 or 3 options, and this is the outcomes based on each one. Here is my recommendation. You're always saying this is what you should do, and no doubt most people go for that, but you're very good at showing, providing the options that they've got, and what is the cash flow outcomes to that. And that's always really impressed me.
Yeah, I think we need to satisfy a broader family dynamic that, they can take an advice document or based on the conversations that we have back to the family group and sit around the table and say, okay, well, here's option A, but here's option B, C, D. And then they may find the one that fits the broader family dynamic. That wasn't initially my recommendation, but obviously the conversations that we'll have with the clients will always evolve, particularly during the implementation phase when actually we are paying deposits and we are updating Centrelink. So we keep it very flexible.
Yeah, fantastic. Very good, Ash. And look, time gets away on it. So for our future chats, when we do these case study ones each week, perhaps we might just do one because, one case study just evolves into so many other questions. But to keep it fair, I'll make sure that I do my second one for you. And this is one where I'm doing, we look after, 200 plus self-managed super funds in our business. It's a core part of what we do, and all our high net worth clients often have self-managed super funds and family trust companies and all sorts of different entities. But some of the time we've been doing, the reviews that I've been doing now, there's two I suppose, calculations that we're doing. The first one that is around, cash flow to make sure that there is enough years ahead to fund their pension. So What we're doing there is we're assessing how much conservative assets, we're talking about term deposits, government bonds, fixed interest, just pure cash, those conservative assets that we can utilise to help fund their pension. The pension's vital. That's the bread, milk and butter onto the table each year. So we've got to make sure that there is ample amount of conservative assets. And so I've put together a very simple calculator, which Ash, you also use as well, where we assess what the income needs are. We net off income less expenses and what's the shortfall. And then we make sure of those conservative assets, whatever that shortfall is, how many years can we fund it? And we're making sure that we're getting people up to probably between 4 years and up to 6 is a bit of a sweet spot, which means our clients will never need to sell down an asset over the next 4 to 6 years to fund their pension. And the reason why we are selling down a bit now to do that is because markets have been very buoyant, all-time highs. We just see that as a really nice opportunity to do it and build those cash reserves. So, because what we don't want to be doing is selling down when markets are are correcting and crashing, and it's not the ideal time to do it. So we've just been shoring up client portfolios from a cash point of view.
Just with that strategy, Rob, to create that liquidity, in some cases, are you going a little bit harder and selling down a bit more than what they may need to hold in cash to service pension payments, to take some funds off the table and potentially buy back in if the markets have a correction at more attractive prices? Are you sort of strategising about market volatility and valuations at the moment?
No, not for new clients that still have money to invest to get into the market. We still have cash that we have ready to go. But for the existing clients that are fully invested, no, generally, I'm not trading. I'm not trying to be that smart, because I know I'm not. I just want to shore up the cash flow. Does that give us the ability to use some of that if the market crashes by X amount of percent? Well, I suppose it gives us the choice at the time that we do have some significant cash reserves. And if the thing goes on sale, the share market goes on sale, well, that's a choice we've actually got, because the fund is well funded from a conservative cash point of view for pension payments.
Fantastic.
Yep.
Thank you.
And in conjunction with that, that short-term calculation, I'm doing the long-term calculation, which answers that, that main question that everyone has: do I have enough? And that's something we've done for so long in our business, and to this day I still think it's the most valuable tool. And whilst we spend a lot of time educating clients where to invest, the strategy around structures, family trust companies, self-managed super funds, all that really important stuff, the stuff that makes people feel really, I suppose, comfortable and knowing that they're in, that they're fine, is proving that they've got enough, to see them through, and enough confidence to spend more money early in their retirement while they have health and fitness. That is a reoccurring theme in everything we do here. But again, it is the thing that moves the needle. It's the size of relief. It's the, you can see them just sink into their chair a little bit more, knowing that, geez, we're there. We have enough, either as a couple or a single. So they're the things we've been doing, and we'd encourage everyone to make sure that their advisor is completing these types of projections. And this can be, well prior to retirement. How much will I need to fund this type of lifestyle? So that's been my week, amongst other things I'd love to chat about, but we can't go on forever.
Thanks for sharing, Rob.
You're welcome. Ash, how can people find you if they want to see a little bit more information, or even ask you a question on one of the socials?
You can look for Ashley Rowan via Google, and I'm sure I'm going to pop up on TikTok or Facebook or Instagram or our website. Google's very powerful, like everyone knows. You can find us pretty quickly.
Very good. And look, when it comes to TikTok, whether it's your account, Ash, or mine, people are allowed to go and put a comment in, even ask a question. That gives us the ability to answer that in a general advice nature, which, of course, this is general advice. But yeah, if anyone's got any topics they'd like us to cover, we are happy to do so. We love to research. It makes us better advisors and communicators. So thanks, everyone, for your time. Ash, thank you for your time, and we'll hope to have another chat
mate.
next week before we close up for the Christmas break.
Sounds good.
Cool. Cheers, Matt. So thanks, Ash.
Thanks, mate.
Thank you, everyone.
Thanks, mate.
Bye.